What's going on? Welcome back to Financial Journey. So today I want to do part 2 to my options tutorial. So it was very heavily requested on how to buy and sell puts. In this specific video, I'm going to be talking on buying calls and selling calls. My previous video, I went over some of the basic fundamentals, so highly recommend you listening to that. It was only less than 1 minute, so very easy stuff. But in this video, I'm going to be talking on buying and selling calls, what that entails, and everything else you need to know. But first, make sure to hit that thumbs up and subscribe. Always greatly appreciate that. And with that said, let's get right to it. So what is a call option, or buying a call? So I'm going to break that down. So as you can kind of see right here, you can always pause the video and break it down and kind of read through this. But technically, a long call right here is you buy a long call. The description is a trader who wants to speculate on a large, fast, and volatile price increase can buy a call. The trader pays a debt, which is called a premium, to buy the call and has the right but not the obligation. That's a big part. They have the right but not the obligation to buy 100 shares at the strike price. 100 shares because one option equates to 100 shares. I kind of broke that down last video. It goes over a actual scenario right here. I'm gonna go over my own scenario, but once again, feel free to pause this and kind of read through that. It goes over right here. The max loss is the cost of the call, so the premium that you did pay. The max position loss would be just the same for that. So of course, there's a lot of different things to talk on, but let's go over it. Starting off with this. So this does have December the 22nd as a expiry date. This is Tesla on a side note, just in case you don't know. And a couple of things to know going into this: the current price of Tesla, which it did close at on Thursday, the 21st, is $254.50. So again, just keep that in mind. Actually, to be fully honest, I have this handy dandy thing up right here. That way you can actually, I'll make notes of that. So going over here, so just using 254.50 as a benchmark. So I'll kind of go over different scenarios. So let's say you feel Tesla is going to go up in the stock price. So whether it is 260 or whatever, you choose a strike price. Keep in mind, this is where things get gray and it could be perceived as gambling because you, in essence, are choosing a strike price. So where the stock might be going by a certain date, so the expiry date. So kind of borderline gambling. So just kind of do your own due diligence and tread cautiously, right? So keep that in mind. So let's say with it at $254.50, you feel it is going to be above, let's say, $260. So you buy a $260 call option. So you can kind of see right here, it is 53 cents. So that 53 cents works out to be $53, like I kind of explained. So 53 cents times by 100 shares, because every one option is 100 shares, you are paying $53. So let's just mark that down right here. So $53 is going to be your premium that you did pay for the right to buy it at $260. To figure out your actual break-even point, what you do is take your strike price plus the premium that you did pay, which in this case is 53 cents. So you need the stock price to be at least above $260.53 for you to make money. So aside from that though, so let's say you feel it's going to go above 260, so you buy a 260 strike price, and let's say it goes to 270. Win-win, right? So technically you get to buy it at 260 despite it closing on Friday at the end of the week at 270. So this is how you make money. You do lose out on your premium. So regardless of the circumstances, you lose out on your premium. But you do get to buy it at a cheaper price. So that's kind of a good thing, right? A couple of things to know when you are buying a call is you need to ensure that you have sufficient amount of margin or cash in your account to satisfy the order, or else your broker will charge you a lot or not even allow you to purchase the initial option. So kind of just be aware of that. Like if you are buying 100 shares of Tesla at $260, you are going to need at least like a lot of money within your account, plain as day. So once again, that's one option. So technically you get to benefit from that, right? Option number two, let's say you buy a call option, you feel it's going to go above 260, and let's say it closes at $259.99. So below this 260 strike price. So the premium that you did pay of $53 is gone. So it expired worthless. So that's kind of the downside of doing call options. So once again, that's kind of just the basic fundamentals of call options. You can choose different expiry dates. So you can choose one very long term, like 2026, 2025, different months. So that's kind of the advantage. If you do really like a stock such as Tesla, SoFi, Lucid, whatever floats your boat out there, and you know, like it might be volatile in the short term, but Lucid is going to do a hell of a lot of good things by 2026. So buy a 2026 call option. That's kind of the mentality of some people. Some people do weekly options. There's lots of different variations. Find out what is best for you. So moving on to the second part right here. And so going over, so this is calls, so long calls. The second one is called covered calls. So this is where you buy, or you already do own 100 shares of a company, and then you sell a call. So pretty basic stuff, right? Description, it says a trader who owns 100 shares of stock may sell or write a covered call. The trader receives a credit called a premium for selling a call and is obligated to sell those 100 shares at the strike price of the call. And a couple things based on this. So break even does vary on this, very similar circumstances to what I previously mentioned, but it does say max contract loss, and that could be anything. Like this is where the sky is the limit in some cases. So once again, this is, make sure you guys do your own due diligence always. So again, I'll just have this up there, and my apologies, I did actually have this blacked out, or kind of the Excel doc over it. So again, pause this if you see justified to go through the description, or if you want to know what covered call is. But moving on, let's go over a real world example of this. So once again, Tesla being at $254.40 or 50 cents. Let's say I go out and I buy it at that price on the open market. So I physically own 100 shares of Tesla. Let's say I feel it's not going to go over $270 by December the 22nd, 2023. And this is where I am selling. So I went over scenarios on buying calls. So someone thinks it's going to go over a certain price. I think otherwise. So someone is willing to pay 6 cents or $6. Remember, take that times by 100. So someone is willing to pay a premium of $6 to buy Tesla at $270. You know what? Why not take that deal, right? Like I said, I just went out on the open market, bought 100 shares at $254.50. Why would I not want to sell it at $270? So I go into that deal. I get that $6 in premiums. So once again, the seller does receive the premiums. The buyer is the one that pays. So once again, that's kind of the basic bones of that, but I receive the premium, and let's go over two different scenarios. So let's say it closes at $280 above the strike price. Well, guess what? My 100 shares is gone. So that individual gets to buy it for $270. To me, that's a win-win, because I just bought it for $254. So I get that capital appreciation. So I bought it $254, selling it for $270. Win-win for me, right? As well, I get that $6 in premiums that someone did pay. So I get both. That's a very good thing for me. Potentially. There's a caveat to that. Obviously, if your average is below that, then you might be selling at a loss. There's a lot of different kind of backstory to that. But in this example, it's a win-win. Let's say, for instance, it closes at $260, whereas I had a $270 strike price, right? So what does happen in that actual circumstance is that I get to keep my 100 shares, and as well, I get to keep that premium. So in that case, I absolutely love that. And so this is where a lot of people do like to sell covered calls long-term on their kind of long-term positions. So whether it be big banks or whatever else, because in that case, they really like the fundamental stock, right? So what they do is they just constantly sell covered calls, they collect the premiums, and if it does go over their strike price, then they sell 100 shares of their actual long-term position, but they can easily buy it back, especially if they do that and strategically are accurate in predicting where a stock might be going. You can actually make some pretty substantial money based on just the premiums that do come in. And so my next part 3 to this, I'm going to be talking on buying and selling puts and what that does entail. And you can actually do a lot of good combination of both in one transaction to make it kind of complex, but that's more for part probably 5, 7, 8, I don't know, later down the line. But no matter what though, if you believe in a stock, then take advantage and do some calls, or just sell covered calls. Keep in mind, there is one thing that you can do is, even based on this, it does go over physically owning the stock. So it says right here, so you buy or already own 100 shares. Technically, you can do what they call naked. So you can sell a naked call, meaning that you technically are selling a call when you don't physically have those shares in your possession. So this is where it kind of gets very speculative, because if you are wrong, and if it does go over your strike price, then you have to go on the open market and buy it, because you don't have the 100 shares to give to that individual, part of your deal. So that's something that you can do. A lot of complex traders like to do that, but this is where, if you look at this information, do calls, whether it be buying or selling, always look at the chart. That is going to give you a good indication of potentially kind of the parameters to really buy or sell options based on. But then again, that's what I do. I'm not a financial advisor. You guys always do your own due diligence. So yeah, let me know your thoughts on calls. Do you buy calls? In my opinion, personally, I surprisingly don't buy that much calls. I just buy a lot of stocks out there that I physically like, and I sell covered calls. A lot of people seem to think otherwise, that I'm not good at predicting stuff, but I absolutely love looking at charts, analyzing where things might be going. And so technically, if you feel that Tesla, in that circumstance, once again, as an example, can get to around maybe $265 by the expiry date, well, then what you do, just to be safe, you can always sell a covered call a couple strike prices above that. So that way you are guaranteed, well, nothing is a guarantee, but you're more likely to just receive the premium and still get to keep your shares. That is typically what I do with a lot of stocks every single week. So I do that as well as sell puts, but that'll be for part 3, like I said. So let me know your thoughts. I have been ranting for quite some time. Hopefully I didn't lose a lot of you, but if you do want further explanation on this, just let me know in the comments below. I always will kind of break it down even further if need be. And some people have asked me which options or which brokers I like to use for options. I do really like to use Interactive Brokers. So I do actually, on a side note, have a link to them in the description below and also the comments. I have probably about 5 different brokers. Each serves their own purpose, but Interactive Brokers is single-handedly what I love to use for options. There's other brokers out there that are free. Interactive Brokers, I think, pays 50 cents per contract. But then again, there's lots of different variables. Always do your own due diligence, like I said. But with all that, let me know your thoughts. Don't forget to hit that thumbs up and subscribe. I always greatly appreciate that. And with that said, I appreciate all of you watching.